Hi guys, welcome to another episode of Building Wealth with Rajeev. Invert, always invert. Great investor Charlie Munger says this all the time. But do you know what it means and how it can be implemented? Well, you would know now after listening to this interview. I chat with investor, teacher, and fantastic human being. He goes by name 10K Diver on Twitter. 10K is a big follower of Warren Buffett and Charlie Munger. So we get together and decode some of the famous quotes of these iconic investors. We try to give some practical touch to these deep quotes. They will certainly shorten your learning journey and help you investing. Please share with your friends if you like this. Please subscribe to my channel for such meaningful conversations. Okay, 10K diver. Fantastic talking to you again. And I didn't know that you were so young. So that's a discovery for me this morning. But fantastic to have you here back. Okay. So
It's lovely to be here. Thank you so much for inviting me along.
yeah, no, it's amazing. I've learned so much from you. So today we are decoding some of the profound quotations of some of the iconic investors, and you follow them. You're a disciple of them. Uh, and uh, I've got a couple of quotes. So let me start with the first one, which I usually hear all the time, which is price is what you pay, value is what you get by Warren Buffett. What do you think? What's your interpretation of that?
Right. So Warren Buffett has a beautiful way of putting things across in a very short, very simple style. But his quotes often require a certain amount of unpacking. So over the years, as you understand more and more about investing, his quotes sort of speak more and more to you over time. And this particular quote, price is what you pay, value is what you get. It's such an absolute, it's almost like a universal truth
Yeah.
in investing. So in investing, there's essentially two things that matter: cash in and cash out.
Yeah.
Right. So what is investing? If you ask somebody, so you put some cash into something, some investing opportunity. It can be a stock, it can be buying a business, it can be buying real estate, whatever. You put some cash in to acquire something, and that something over a long period of time gives you cash by itself. So if it's a business, it may give you dividends over time. If it's a real estate property, you may be able to collect rental income on it. If it is a farm, you may be able to sell the crop and get some money that way. Whatever it is, you put some cash in, and then over time you take cash out. And hopefully, investing is putting in a small amount of cash and taking out a large amount of cash over
Yeah.
time. If you can do that, that means you're earning a good return over
Agreed.
time. That's in its simplest terms, that's what investing is.
Yeah.
And so what Warren Buffett is saying here is it's as simple as that. You try to pay as low a price as you can for something, and over time that something will generate cash for you. That is the value that you get out of it, and you try to get as much value out of it as you can. And so price is what you pay, value is what you get. And if the value that you get out of something is more than the price that you pay for it, you have a positive return on your investment, and over time you will do reasonably well. If you habitually overpay for things and you pay too much for something that doesn't generate that much value for you, then over time your results will be much poorer. This is like a fundamental truth of investing. And I very much like Jim O'Shaughnessy. I don't know if you follow him on Twitter. He's
I
a
do.
great guy.
Yeah.
And he has this little story that he goes about telling people.
Sure.
And so I had him on my podcast recently, and
Okay.
he narrated the story, which is so imagine you're in New York, okay, and you get some food off of a taco truck or something like that. You
Mm.
buy some tacos and you eat them, and you find that these tacos are really really good, and so you want to buy this taco truck. So
Mm.
you go to the guy who runs the taco truck and you say, hey, you make absolutely great tacos. We want to buy your taco truck. How much do you do in revenues and profits and all that? And that guy says, okay, I have say I have $200,000 in revenues every year, and then I make $100,000 in profits. Just throwing some random numbers. And if he says he throws $100,000 in profits every year, and then you ask him, okay, how much do you want for this taco truck business of yours? If he says, okay, I make 100,000 a year, give me 500,000, and you can have the taco truck. That's somewhat reasonable. Like, okay, fine. 500,000 means if you buy the taco truck for 500,000 in 5 years, even if you change nothing, you will make your money back, and then after that, whatever you make is yours to keep, right?
Yeah.
Seems like a reasonable thing. But suppose this guy says, no, I want $50 million for this taco truck. Immediately, right there, you're going to say, no, man, sorry, your price is too high, right? Because there's no way I can make the numbers work. If I pay you 50 million for a taco truck that's going to earn 100,000, it'll take me 10 years just to make 1 million. And if I have to make 50 million, it will take me 500 years just to make my money back.
Yeah.
That's just not going to work. So price is what you pay, value is what you get. If you pay too high a price for something, even if it is the best taco truck, it may not be a good investment. And this example is what Jim O'Shaughnessy likes to give out. And the funny thing is, everybody understands paying for a whole business. This makes absolute sense. Like, if you want to pay for the whole business of the taco truck, yes, this is how you think about it. But if you slice that business up into small parts, that's essentially what a stock is. You take a business, say IBM or Apple or Nike or any business, you slice it up into a large number of small parts. People are willing to pay exorbitant prices for these small shares of businesses, even though if they had to buy the whole business at that price, they would never pay that price. This is people just being irrational in the markets, people letting their hopes and dreams for the business run ahead, letting their imaginations run ahead of themselves. And so we see things like this happening in the markets that we will not see if people thought of stocks as pieces of business. People tend to think of stocks as pieces of paper to be traded back and forth. If I can buy this piece of paper for something and then sell it to someone else at for double the price that I paid for tomorrow, then I'm rich, so on. But there is a business under that piece of paper. And if you just focus on the fundamentals and focus on the business that that piece of paper represents, then you will make better financial decisions over time. That is the way Warren Buffett thinks about businesses. That's the way most successful investors that I know, almost all successful investors, that's the way they think about businesses, and so on. How much cash do I put in? How much cash do I get to take out over time? And does the equation make sense or not?
But how do you? I think this is fantastic, and this taco truck example was really great. And my question is, or my clarification further is, how do you live up to it? I mean, you want to buy a business, let's say 10K today, and how do you value that business? What's your way? I mean, everybody can have its own way, but what's your way?
Well, if you go by the traditional definition of value, you take all the future cash flows of the business that a shareholder is going to get. So all the cash flows per share, and you discount those cash flows over time using some reasonable discount rate, and whatever you get at the end of that exercise, that is the value. So for example, if I'm looking to buy a business, say Apple or something like that, I have to estimate what future cash flows Apple as a business is going to have, what portion of those cash flows they will be reinvesting back into themselves, and what portion they will be giving back to me over time. And whatever cash flows that Apple gives to me over time, if I want to make, say, a 12% return on this particular stock over time, I will take the cash flows and discount them at 12%, and I will arrive at a particular price. And that price is how much I can pay for Apple if I want that 12% return. So if let's say the price that I arrive at is $100 a share or something like that. So according to my estimate, these are all estimates. So no one knows how much Apple is going to earn tomorrow, or how many iPhones Apple is going to sell tomorrow, and so on. But you make some reasonable estimate based on what you think is going to happen in the future. And if your estimate is right, then if you pay $100 for this particular share of Apple, you will make a 12% return. That's what this whole exercise tells you. And so it's very obvious, if you pay more than $100, your return is going to be less than 12%. And if you pay less than $100, your return is going to be even more than 12%. If your estimations are correct, you buy the shares and then you hold on to them forever. So this is essentially what intrinsic value analysis is.
And that's how you look at it when you are buying the stocks.
Well, I look at a few different things when I'm buying stocks. So this is the simplest traditional way to start off with.
Okay.
So this is what, for example, Professor Aswath Damodaran, if you take one of the valuations that he regularly puts out, you will see this being done in his valuation. You take his spreadsheets, and then you look at the cash flows. He will take the free cash flows or dividends or something like that. He will discount them to today using some applicable discount rate. And he will get a particular value for the company, and he will say, okay, this is the value that I will pay. I will not pay above this. I will not. I will try to get it for cheaper than this value. This is his valuation of a business. This is how valuation typically works.
I think last time when you came, we talked a bit about valuation, quite a bit on various methods. Also, you talked about the inverse DCF also. So
right.
Yeah, I think moving on. I think for valuation, I guess they can hear the last interview as well, and there's a lot you write on Twitter. I just moved to the second quote now, 10K.
Okay.
Which is in the short run, the market is a voting machine. In the long run, it's a weighing machine. Man, I have not been able to understand it, because voting machine, weighing machine, weighing machine, voting machine. I don't know. I keep getting confused about it.
Well, so if it makes you feel any better, if you look at the study of voting machines, all these cryptographers who try to devise machines for voting and things like that, they keep saying, don't trust our voting machines, and just vote in person as well. so if it makes you feel any better, the world doesn't understand voting machines as well. But I think this is a quote by Ben Graham. And Ben Graham, as Warren Buffett's teacher, I think Warren Buffett learned from him how to put things in a simple, easy to digest way. So what Ben Graham, I think, is trying to say, I don't want to put words into Ben Graham's mouth. But to me, what this says is, in the short run, what moves prices is essentially supply and demand and sentiment in the stock market. So if Apple comes out with a very good earnings report or something like that, they sell way more iPhones than what anybody expected or something like that, then everybody immediately thinks, oh, Apple is a way better company than I thought it was, and then rushes in to buy shares. And people are also reluctant to sell shares because Apple has just proved that it's a great company. And so if you have people who are reluctant to sell, and if you have people who are eager to buy, only one thing can happen: the price has to go up. So the price of the Apple shares goes up. So in the short run, so say 1 or 2 days after Apple reports earnings or something like that, what drives the price of Apple is sentiment and supply and demand, essentially. So people vote with their money in some sense. But in the long run, if you take a look at what drives prices, it is essentially the performance of Apple over a long period of time, not just one particular quarter's results or some news coming out saying Tim Cook is going to build an electric vehicle or whatever. It is what Apple delivers over a very long period of time. The growth in earnings, the growth in cash flows, the growth in revenues, the products that they develop, and the cash flows that they generate and distribute to shareholders over time, the capital allocation decisions at the company. These are all the things that drive the long-term performance of the stock. So if you take the long-term price chart of a company, say over 10 years or 20 years, and you just plot, okay, what is the growth in its earnings and what is the growth in its stock price. Over the long term, these two things tend to be highly correlated. Whereas in the short term, you could have sentiment or market direction. Sometimes people are euphoric about a stock. Sometimes people are very pessimistic about a stock. And that all tends to drive returns. But if you just wait and zoom out and look over the long term, generally growth in fundamentals like earnings and cash flows and things like that, that is what determines returns for investors.
Very, very beautifully explained, 10K. And, it clears me up and makes me think about some of the stocks like C Limited, for example. I'm not doubting it's still one of my holdings, and significant amount of money for me is invested in the company. But if in the month of January or maybe last year, everybody like C Limited is a beast. C Limited is a beast. And
Right.
every day I will see the damn price rise by 10%, 5%, 8%. And I used to wonder, what has it done to go up 8% every day? It's touching new high every day. And the earnings came a quarter back, and just today came they're expanding to Brazil, and it's 8% high. And now the stock is cut into like 1/5 of what it was. Now, might be recessionary macro factors, but I think there was clearly some wisdom if I relate what you said to that. It was supply and demand. And now maybe, people are getting so euphoric. No.
Exactly.
Yeah.
In fact, Michael Mauboussin, who's another great person I follow on Twitter, great professor, he likes to say that in investing, it's not about picking the horse that is going to win. It's about picking the horse whose chances of winning are the most mispriced. So what he means by that is, sure, C Limited may be a wonderful company, but if everybody knows that it's a wonderful company and everybody expects the company to do really, really well over time because it is a beast or whatever, then people are going to bid up the price of the shares. And so the price is going to go up and up and up. And ultimately, it comes back to the first quote that we said, like, how much are you willing to pay for this taco truck? If people have bid up the price of this taco truck to say $50 million, and the taco truck makes $100,000, it may be selling the world's best tacos, but it's hard to make money off of it when you buy it for such a high price. So ultimately, price is what you pay and value is what you get out of it. And if that equation doesn't make sense because people have too rosy expectations for the company, then sooner or later, those expectations will have to meet reality. And when they meet reality, that may be...
It may not be very pleasant.
Yeah, it's unlikely to be very pleasant, especially for people who bought later on.
I don't know whether you remember that or no, but last time when we were chatting, I was talking to you about Shopify price, right? And it was
right. We were talking about Shopify.
Yeah, 1,500, and you generally are a very gentle person, and you didn't really say a lot of harsh things, but you were skeptical about it. And now I think maybe the macro environment is bad, but the correction is like ruthless. Now, you know what? It brings me to a related. I'm just breaking the flow, but it's bringing me to a related one. Charlie Munger said, "Mimicking the herd invites regression to the mean." Do you think it gels with you when I'm giving example of C limited and you're talking about voting and weighing machine?
Oh, absolutely, absolutely. So Charlie Munger in this case, uh, another great investor, another person I admire a lot. What what he's essentially saying is, if you do what everybody else does, you will get the returns that everybody else does gets,
Yeah, yeah,
right?
yeah.
So uh, if you have to succeed as an active investor, so you can be a passive investor and just buy the index, and you'll get the returns that the index delivers over time. But if you want to be an active investor, a successful active investor, in some place you have to depart from what everyone else is doing, because if everyone does the same thing, they will all get the same results. In fact, I think it was Einstein who said, the definition of insanity is to do the same thing over and over and expect different results. And it's somewhat true in investing as well. Although when you have a lot of uncertainty that's driving the situation, you can do the same thing and get two different results if there's a lot of randomness in the process. But uh, essentially, what Charlie Munger says is, uh, an active investor has to balance two things very carefully. One is uh, to acknowledge that the market is very, very smart. So there is real wisdom in crowds. And so most of the time, the market is going to be right. And if you have a contrarian view, um, if you think a particular stock is being underpriced by the market or being overpriced by the market, and so on, you are likely to be wrong simply because the market is right so often. But at the same time, uh, you should also have the ability to think independently and come to your own assessment of things, regardless of what Mr. Market is telling you. And from time to time, hopefully, you will have some insights where you are right and the market is wrong. And if you can capture a few of these insights over time, and if you can bet big on these insights, you're likely to be very, very successful as an investor. It's just very hard to do. So you can't just follow the herd all the time, because sometimes the herd is jumping off a cliff. So you should
Hmm.
know when not to follow the herd and jump off the cliff. Um,
Yeah.
and you shouldn't go against the herd all the time, because the herd is right most of the time. Most of the time, it's not jumping off of the cliff. So an active investor needs to have that contrarian streak, that independence of thought in them, the ability to sort of do your own analysis and trust your own judgment, even when the market is saying something different, but at the same time defer to the wisdom of the market, saying, uh, if the market is telling me that this is the price, what am I missing? What do I not see in that situation or whatever? Because the market is usually right. So, uh, it, people
It's
who
pretty
are great
complicated,
in
isn't it? I mean,
it
because
is.
demand and supply at one time is like a voting machine, but longer run we're talking about weighing machines. So I think it's not easy to differentiate, and
Exactly. And a lot of the time, as I said, the market is right about a company. So companies that have great economics are generally priced very high in the market. So the market recognizes that these companies have great economics, and that is also a problem for the individual investor, individual active investor, because when a company is priced so high that its future returns are likely to be disappointing, you have to understand that uh, the market may think this is a great business, but a great business may or may not be a great investment
Yeah.
opportunity.
Yeah.
So yes, I mean, active investing is a tough game. It is a game where the odds are not really on our side. So most active investors over a long period of time, they tend to underperform the S&P 500. Uh, uh,
Mm-hmm.
that that is the game we are all playing when we do active investing. So it's important to be humble, to recognize our limitations, and uh, to try to have conviction, and try to bet on a few things where we think we have an edge. But it's not an easy game by
It's not an easy
in any
game.
stretch.
No. I
Yes.
think something which looked fantastic 2 years ago looks like shit now. You know, if you just follow the pricing, then a company which looked wonderful 2 years ago is looking like a shit company now. Maybe the fundamentals haven't changed. So I think the quality of business and the price, I think two different dimensions, and that's where the value comes in, I guess. What you're talking about now.
Yes, absolutely.
Yeah. So this takes me into another quotation of legendary Warren Buffett. He says that, so I think the question is when to buy. Yeah. I mean, you see that there are markets of irrational exuberance. There is value, there is price, there is demand and supply. There is a lot of factors. Now, when to buy? And he says that, uh, you know, be fearful when others are greedy and be greedy when others are fearful. Now, this is some indication into buying point or buying time, isn't it?
Well, yes. So I think what Warren Buffett means by this quote, it's actually twofold.
Okay.
So I, I I mean, the first part is being fearful when others are greedy. So that is almost like selling, or when not buying, at least when there
Okay.
are too many people who have bid up the price of security. So we saw this, we've been seeing bubbles
Yeah.
in
Last
markets
year,
for a very
last.
very long
Yeah.
time.
Yeah. Yeah. Yeah.
There was the tulip, uh, the tulip bubble in the Netherlands. I think in the 1600s or something like that,
Uh,
where the price of one tulip was equal to the price of a nice house or something like that.
wow.
So we've been seeing periods where companies and stocks have been bid up to crazy levels. We saw this in the dot com, just leading up to the dot com crash, in the couple of years leading up to the dot com crash. Anything that had a dot com after its name, the stock price would just shoot into the
Blow up.
stratosphere. And
Yeah.
most of these companies, they did not have much in the way of earnings or revenues or cash flows, and people were saying that the whole world is different now. The
Mm.
internet is going to change everything. And by the way, I mean, many of
It
them
has.
were right. They were
Yeah.
just too early.
Yeah.
so
Yeah.
so uh, uh, People who thought, pets.com is going to completely change the world, they were not entirely wrong. We have Chewy today, which is a super successful company. Uh, I know, because we spent a lot of money on Chewy. We have two
Two
puppies at
dogs.
home.
Yeah.
Yeah. uh, but this just goes to show how hard a game this is. When people get too exuberant about a particular company or a particular set of companies or something like that, companies in a particular sector or something, uh, what usually follows is pain, because they again tend to bid up the prices of these stocks, and they lose all sense of fear, and greed replaces that fear. And we have to be very careful buying into that sort of thing, because 2 months later, the greed may be completely replaced by fear, and there may be a huge crash, uh, when people realize that uh, these things are not sustainable in the long run. So you quoted the example of C Limited, for example. You can't expect a stock to go up 8% every single day or something like that. It's just not sustainable.
Yeah.
So sooner or later, that has to stop. And of course, everyone knows that it has to stop, and they to some extent, people in these markets, the price in some sense makes us behave irrationally. So when we buy something and then it rises, say 20% in 1 week, we feel like geniuses, and we
Yeah.
think, okay, I will get out just before the top or something like that. And sometimes we are lucky, sometimes we are not lucky, and we are the ones left holding the bag. So
I
it's
remember,
generally,
I remember 10K, sorry to interrupt you. I remember that I was fighting with people when the price was going so much, and they were saying, "Oh, it's like tulip kind of phenomenon." I was finding reasons to justify why the price is going up. The kind of confirmation bias all the time was ruling me, and then came a shock and corrected everything. But anyway, carry on.
right, exactly. And so conversely, the other part of the saying is be greedy when others are fearful. And so when there's a lot of fear in the markets, when people don't know whether, so in 2008 and 2009, for example, people thought the entire US economy and the entire world economy was done. Similarly, during 2020 March, during the COVID crisis, people thought that this is going to be a huge crisis. It's going to bring on a big recession. That recession is going to become a depression, and recovery is going to take a long time. And so there was a lot of doom and gloom in the
Hmm.
markets. And so when that happens, when people think the future cash flows of businesses uh, is going to suffer a great deal, what happens is they tend to bid down the price of stocks. And so it turns out that people, humans generally, we overreact to things. So when things are going well, we think the good times will continue forever. And when things are going badly, we believe that the bad times will go on forever. And we have a tendency to overreact. And because of this tendency to overreact, it's usually a good idea to buy stocks when they're trading dirt cheap. So there's this other saying, buy when there's blood on the streets. So that's essentially what it means, is when people are so pessimistic that they think these companies are never going to recover, or there's no way uh, the economy is going to improve or something like that, usually they are wrong. And the economy eventually recovers, and good companies that are managed reasonably well, they eventually recover. And so when they recover, their stocks also recover along with them. And so there is this uh, famous saying, "This too shall pass." And
Yeah.
uh, whether you're in irrational exuberance or deep pessimism, it's always good to remember that most likely this too shall pass.
Yeah.
And so when the pendulum turns the other way, you have to sort of be ready to position yourselves in such a way that you can capitalize on the pendulum turning.
Yeah.
And that's exactly what this fearful and greedy uh, quote is about. But
Amazing.
it's not just, as I said, there is wisdom in crowds as well. So you need some long-term orientation. So the crowd is usually right about a mid-term thing. Like for example, if in 2008 and 2009, there was a recession, and there was a real chance that if the Fed had not intervened or whatever, if all the steps that central bankers around the world and others took, if they had not been taken on a timely basis, maybe the crisis would have been a lot more severe, and so on. Uh, so there was an eventual recovery, but it took some time, and so we have to remain patient over time. So it's not just about the crowd may be right that there is a recession uh, that's about to happen or something like that. The crowd may Where the crowd may be wrong is that this is going to be the state of affairs forever from now to infinity. That is
Yeah.
where the crowd may be wrong. because the crowd may be myopic. They may not be seeing beyond the next few quarters or years. And if you can sort of look beyond the current crisis or the current period of irrational exuberance across over the long term, you may be better positioned as an investor. Although this is much harder to do than to say.
Yeah. No, so I think on this, the buying time, let's take about March of this. I think right now, I think I'm seeing market is doing slightly better. But March, April of this month, do you say that is a good, that was in retrospect a good buying time because everybody was so fearful? Is that an example of that?
Well, so I am an active investor, so I look for individual stocks, individual companies, and try to buy them because I enjoy the process of investing and I like learning about companies and so on. I know the odds are against me. So it's true that earlier in March and April of 2022, a lot of stocks got beaten down. And some of those stocks still haven't recovered fully, or even they were not fully recovered from where they were, although they are higher up today than what they were in March and April.
Yeah.
So I don't know if the stocks were beaten down to the level that I would be comfortable buying them.
Okay.
So we did not see too many opportunities for my own portfolio, for our own portfolio, my family's portfolio, which I manage.
Okay.
But I may be completely wrong. Maybe it was a great time to buy and I just missed it, or something like that. Also, the kinds of companies that got heavily beaten down, those were generally high tech companies and
High growth.
high growth companies that were already pretty expensive to begin with. So that is not that's not really the universe of companies that I look at when I try to buy them. So I don't know if it was a great time to buy or not. It may have been a great time to buy these kinds of companies, but to me, when I buy a company for our portfolio, I want to be reasonably confident that I understand the long-term economics of these companies. And many of the companies that got beaten down 60%, 70%, 80%, I didn't really understand their economics that well, or I didn't really have a differentiated view about what their long-term economic performance is going to look like. So when I don't understand things, I don't put my money, our money there. So
I think it's for everybody. You put your money when you have conviction. There's no point following some advice, or I think it's your money. So I think what you did is the right thing. There was a bit of sector rotation. It was a little complicated than just there was not a huge, there was no market wide meltdown, so to say. I mean, there were some stocks which fell much more than others. I think it was a little complicated situation. I get it. No.
Right, exactly. So if you look at the S&P 500, for example, I think it dropped down 11% or 12% or something like that. Whereas if you look at many individual stocks that were sort of high flyers in 2022,
60-70% down, 60 to 70% down.
Right.
Snowflake,
exactly.
Datadog, and Nasdaq itself was more than 25% down. So I think there was a lot of technology. The fall was more tilted in favor of technology. Now, one thing, on decision making again, demand, supply, valuation, I keep hearing invert, always invert, something Charlie Munger said. And, I have never understood. I'll be very frank with you. I run this YouTube channel, Invest, but I don't know what that inversion means and how to invert. And, I mean, I get a sense of it. Yeah. I mean, you think in one direction, then you think in another direction. And what do you make out of it? It's a tough quote for me, trust me.
Right. So Charlie Munger is a guy who has a lot of mental models, as he likes to call them.
Yeah.
And this invert is a kind of problem solving technique that has been used a lot in a variety of different fields. So when Charlie Munger says invert, always invert, he is actually quoting another mathematician, Carl Jacobi, who
Oh,
first
okay.
said
Okay.
invert, always invert.
Okay.
So in mathematics, uh, usually, if you're not able to solve a problem from the beginning, it's often a good idea to look at the end, the answer that you want to get, and sort of try and figure out how to get to that answer. If I have to get to this particular answer, well, what should the immediately preceding step of the solution look like, and then go from there. So something like that.
Okay.
So it's a great mathematical technique to solve puzzles. So there is this famous puzzle called the birthday paradox, for example. So
Okay.
if you have say 50 people in a room, what are the chances that at least two of them have the same birthday? Now, this is a problem that is if you try to solve it, what are the if you try to list all the possible ways that at least two of the 50 have the same birthday, you'll most likely go mad, because there are just so many possibilities. See, person
Mm.
1 and person 2 can have the same birthday, or person 1 and person 49 can have the same
Uh,
birthday, which could be different from the person 37's birthday, and and so on. There's just an enormous number of different cases
yeah.
to handle, and it's impossible to count all of them. But if you invert the problem, if you ask, okay, what are the chances that no two people have the same birthday? So
Okay.
what are the chances that they all have different birthdays, right? That is a much easier problem to solve, because once you've assigned a birthday to a particular person, that birthday becomes unavailable to assign to anybody else, right? So uh, you can solve this problem very easily if you just think about the inverse of the problem. So what are all the ways that no two people have the same birthday? Is much easier to solve than what are all the ways where at least two people have the same birthday. And if you're talking in probabilistic terms, these two events are kind of opposites of each other. So if the probability of one of them is p, the probability of the other has to be 1 minus p, or 100% minus p. So you can get the probability of one by calculating the probability of the other, which is its opposite. So that is where Charlie Munger is coming from. Now, how do you take this and apply it to investing?
Yeah,
Right.
that's a
That's what
question.
we are.
Yeah, yeah,
Yeah.
yeah.
So it's great when you talk about mathematics and how you can apply this inversion principle. So I think what Charlie Munger he has sort of expanded on this in multiple different contexts. So I think what he's trying to say is, uh, don't look at the upside in an investment. So of course, we when we buy stocks, we all look at the upside and we say, okay, these are all the good things that can happen to this company over time, and uh, we want to benefit from all these good things, and so that's why we are buying the stock today, so that we can benefit from all the good things. But what Charlie Munger says is invert, in the sense, don't look at all the things that can go right. Look at all the things that can go wrong with the company, right? That
Okay,
that
okay,
is
okay.
an
Okay.
example of inversion. So, what are all the things that can go wrong with this company? And if the worst thing that can go wrong is that, say, the company will get into say 2 years of underperformance or something like that, but then it's always going to come back, then you have a great company. So uh, figure out the downside first.
The worst
Look
possible
at the downside.
scenarios.
Exactly. And
Okay.
in fact, Charlie Munger has this very nice example where he said he was actually before he became a lawyer and an investor and all that. He was actually on the ground in charge of providing air traffic support or something like that to pilots up in the air. So
Okay.
it was his job to provide air traffic support or something like that. And he said he applied this exact same philosophy to that. He said, okay, what are all the ways that uh, this thing can go wrong. So what are the ways that I can kill a pilot, essentially? So he said that there are two main ways I can kill a pilot. So if I get him into really bad weather that he's not able to get out of, then he will die. And the second situation is if I get him to a place where he doesn't have enough fuel to make it back, then he can die. These are the two big main ways that pilots can die. So just work really, really hard to make sure these two things don't happen. So if there's bad weather somewhere, just do your best to steer clear of the bad weather, and always keep an eye on how much fuel you have, and never get into a situation where you don't have enough fuel to get back or get to your destination or something like that. These are the two big things. If you just avoid these two big mistakes, there's a good chance that the pilot will land safe. So same thing with the investing. If you just avoid huge mistakes, like for example, putting all your money on a single stock, right? So if something bad happens to that one company, it takes down your entire portfolio along with it. So don't get into situations like that, or borrowing a huge amount of money and then using that money to buy stocks. So if you get margin called or something like that, if you take out a huge margin loan, you may be right about the company in the long term. So you may buy a great, wonderful business with the margin money. But if there happens to be a 10%, 20% short-term drop in the company stock, then you may get margin called. And then once you get margin called, it's game over. You've essentially turned short-term volatility into long-term risk. One thing,
long-term liability for yours.
Exactly. So if something bad happens in the short term, you're dead essentially. So avoid these kinds of situations where a single thing going wrong can completely wipe you out. And as long as you avoid these big mistakes in investing, there's a reasonable chance that the returns will take care of themselves over time. So just try not to be, just try consistently not to be stupid, kind of. That's what Charlie Munger and Warren Buffett like to say. We don't try to hit the ball out of the park. We just try to avoid big mistakes.
Yeah, no, I think that's so critical in life also. Like buying insurance is more important than having a big salary package, if you ask me. Because if something goes wrong and if you're hospitalized for 2 months, you're dead, man. Whatever you've saved for years will go down the drain. So having an insurance is very, very good.
Absolutely, that is a great point. Yeah. And Professor Mauboussin, again, Michael Mauboussin, he's done great work on this, and he has his own interpretation on the always invert idea. And his idea is, instead of asking what a security is worth, right? So we're all trying to value companies. So his idea is take a DCF and invert the DCF on its head to find what he does is a process called a reverse DCF or expectations investing. So that is also an example of invert being applied in an investing context. So what we want to do is, typically when we want to value a security, a stock, say, we try to predict the future cash flows of the company, and then we discount those cash flows to today and try to arrive at a value for the company. And what Professor Mauboussin says is turn the process on its head. So let's imagine what the value of the company is today. So let's say that the market price for the company is correct. Okay. So if the market values this company at $100 a share, fine. Let's just say that is the value that we want to get out of this DCF process. So what should the cash flows of this company look like so that the value, when you apply this process, works out to exactly $100? So in other words, what do I have to believe about the future of this company for the market price to be, quote unquote, the right price? Just understand what are the expectations that are currently baked in to the stock. And then you can have a view on whether you think these expectations are overly optimistic or overly pessimistic or whatever. And then If they're overly optimistic, then you say, okay, this is not a candidate for my portfolio. But if the market is expecting this company, this wonderful company, to grow at, say, 1% a year or something like that, whereas you think this company is going to grow at 10% a year, then your expectations of future performance are much higher than what the market expects of this stock. And so that may be a good candidate for your portfolio. So just turn the problem on its head. Instead of asking what is the right value for this company, ask what are the expectations that are built in, if the value of the companies should be exactly equal to the market price. So that is an example of inversion that's applied to investing as well. So these are all the ways that
That's beautiful. I think
yeah.
amazing the way you've explained and get over. And it makes me feel clearly one thing, that active investing is no less than becoming a very trained specialist or a gynecologist or an engineer or an architect or ballet dancer. I think active investing is something like that. And people look at price and demand supply, they think the investing is like learned overnight, right? It's a very special game.
Well, absolutely. I can tell you that I didn't learn these things overnight.
No, I know.
It took me way longer than what it should have taken me in retrospect to learn some of these concepts. But that's why we are here, right? We're trying to help
Other
others
people to
get this knowledge.
shorten their learning curve.
Yeah, with much less effort than what it took us to learn these things.
Yeah. I think last thing, in the spirit of time, I have selected these, some of these things, and you were kind enough to talk about them, and I think some of them are your favorite as well. But what is your most favorite quotation which inspires you, which you want to talk about, and then we end the show with?
Right. So I have a number of favorite quotes, but one thing that I think is very applicable to this particular podcast is this Charlie Munger quote. And when I was going through the book Poor Charlie's Almanac, for some reason I stopped at this quote, and when I worked out the math behind this quote, it really had a big effect on my thinking as an investor. So here is the quote. This is what Charlie Munger says. He says, imagine you have two companies, right?
Yeah.
There's company A, which earns 6% on capital, and you have company B, which earns 18% on capital. What Charlie Munger says is, over a long period of time, the return that an investor will make from investing in either of these companies will be roughly equal to the return that the companies themselves make on the capital that they have. So it doesn't really matter. So we, as investors, we want to buy companies. We want to buy high quality companies. We want to buy them at really low prices, and we want to hold them for long periods of time, right? And what Charlie Munger says is, yes, buying high quality companies is super important. Holding them for long periods of time is super important. But the price, the buying them at a low price, that part is not as important if the first two conditions, high quality and long time, are satisfied. So what he says is, if you take this company that earns 6% on capital, right?
Mm-hmm.
And you buy that company at a very, very cheap price. Let's say you buy it at half of book value, or one third of book value, or whatever, some really cheap price, or 5 times earnings, or something like that. And you own this company for 30 years, 40 years. At the end of those 30 years, 40 years, if you calculate what your return is going to be from this company, even if you manage to buy it at a cheap price and sell it at an expensive looking price, your return is not going to be very different from 6%. It may be 8% or 9% if you manage to get buy it at a really, really cheap price and sell it at a really, really expensive price. But it's not going to be that much different than the 6%.
Okay.
Whereas if you take the 18% earner, the company that earns 18% on its capital and is able to reinvest those earnings back into the business at the same 18% return. If you hold that company for, say, 30 years, even if you pay a really, really expensive price, say 50 times earnings or 60 times earnings to begin with, a very expensive looking price, even if you pay that price to begin with, if you just hold it for this long period of time, and when you sell it, even if you don't get such a great price, even if you're able to sell it at just say 20 times earnings, you bought it at 50 times earnings, but you sell it only at 20 times earnings, even then you will make a phenomenal return. You may get something close to 18%, say 14% or 15% or something like that. So what is important is the return that a business earns on its capital, and to what extent the business is able to reinvest back into itself at those high rates of return. These are the two things that matter for investors over a long period of time, not so much the price at which you buy these companies. So that is what Charlie Munger is driving at. And of course, so everything that we said earlier in this podcast about paying too much for a company, it still applies. So you can't pay, say, 5,000 times earnings for a company and expect to do really, really well, because it might take you a really long time to get any return whatsoever. So that there are limitations and there are caveats around this Charlie Munger quote. It's not like saying, yeah, if the company is great, you can pay any price for it or whatever. But there is a good chance that you can pay what is normally considered an expensive looking price for a high quality company and still do reasonably well if you just hold the company for a long period of time and that company remains high quality for a long period of time. If you just work out the math behind this quote, just figure out what the earnings are going to grow at and figure out what the market cap of the company is going to be, what your return as an investor are going to be over the long term if you just buy and hold this company. It really made a big impact on me when I first understood this quote. So this is one of my favorite quotes in all of investing.
That's amazing. I've heard of this so many times, and my thinking intuition is that that's where the whole concept of fair price came in. I've heard this, that Charlie Munger was the one who influenced Warren Buffett thinking into pricing. Not don't look for the cheap price, or look for a fair price. And you know, fair price is a bit of a shadowed word, but it has those deep meaning which you're just talking about. How to look at a fair price. I mean, uh,
Exactly. So if you have a really high quality business, you can afford to pay up a little bit more for it and still do very
yeah,
well over the long term.
yeah. All right. I think 10K, amazing. Thank you so much for helping the people. I think people who will hear this will benefit a lot. And you have a big fan following. People love, reading your Twitter quotes or Twitter things. They're a bit difficult for me sometimes, but they're amazing. And thank you for decoding it. I really, really appreciate your time.
Uh, thank you very much, Rajeev, for having me on. I enjoyed it very much.
Yeah.
Thank you. Have a great day.